We have a great question here from a new subscriber about gold, saying that if the market thinks that inflation is moving up, which has been the case, obviously, looking at inflation expectations here in purple, if the market thinks that inflation is moving higher, and since gold is also seen as an inflation hedge, shouldn't gold also be moving higher as in inflation expectations has also been pushing higher as well? So I think this is a great question, by the way, and something that we've had other similar questions about in the terminal recently, talking about gold and real interest rates, etc. So you are right. Gold, has traditionally been seen as an inflation hedge because it is a hard asset that keeps its value. So as fiat currencies lose value when inflation rises, gold shouldn't. So it's seen as a hedge for when inflation goes up. However, I think there are two very important reasons why gold is moving or not moving up alongside inflation expectations right now. And the first reason is that even though gold is seen as an inflation hedge, its strongest driver by far is real yields or real interest rates, which, as you know, is nominal bond yields minus inflation expectations. So let's just get a US 10-year on the screen here for a second. So this one in the blue is US 10-year, which is US 10-year bond yields. And you can see that even though inflation expectations has been moving higher, so too has US 10-year. And the current steepening in the yield curve has been very impressive recently that we've seen from the yields at the back end of the curve. So remember that fixed income assets like bonds, they hate inflation because inflation erodes the future value of money. So if inflation rises, that's normally bad for bonds. And as investors rotate out of bonds, selling their bonds, that obviously pushes bond yields higher. Now, bond yields don't only move up, of course, due to inflation expectations alone. There's also, better prospects for growth alongside that of inflation, which, of course, is also good from a yield steepening point of view. Now, those that do trade bonds, they can, of course, still hold things like treasuries, even with inflation moving higher, but then they'll rather opt for something like inflation-protected treasuries like TIPS. So I think the first reason why gold isn't going up despite rising inflation expectations is that US 10-year or nominal bond yields has also been moving higher at a very fast pace. And yes, real yields are still very low and they are slightly drifting lower. But because there is that anticipation of steeper curves going into the rest of this year, the market is expecting real yields to rise. And even though it might be by a small amount, as inflation expectations also rise, I think that is a very negative input for gold right now. The second reason, and this is where it does get a little bit speculative on my side at least, is that I think the current market environment where we are in is bad for gold, even if inflation expectations rise. And let me explain why. Think about it from a portfolio manager point of view. Imagine that you are a portfolio manager and you've got different allocations in your portfolio, 40% to bonds and maybe 50% to equities, and you're holding 10% of your allocation in gold, or 5%, or whatever it might be. Let's just say it's 10% for argument's sake. Now, you might be holding gold more for its safe haven qualities in the case that things turn sour, and that makes sense. But holding it as an inflation hedge in the current market environment doesn't really make sense for me from a potential return point of view. So if you really wanted to protect your portfolio against inflation and you want to use gold for that purpose, then you would actually, it would only make sense for you to do that if your portfolio was 100% allocated in gold. Otherwise, you are just protecting that 5 or that 10% of your portfolio that is allocated to gold against the expected inflation move. So what makes more sense for me, at least from a portfolio point of view, is to allocate other parts of your portfolio to other assets which will potentially outperform inflation. So not assets that just wants to hedge against inflation, but assets that can actually outperform inflation. So for me, in the current reflationary environment, if you really wanted to hedge against inflation, then, wouldn't you rather allocate to assets that are more correlated to inflation compared to gold, and are actually expected to perform really well in a reflationary environment? So for me, that makes a lot of sense. more sense than holding gold for an inflation hedge point of view. Why only hedge against inflation if you can actually make money from that potential move that you're expecting to happen in inflation? So for me, an obvious way to rotate, away from gold and into other assets would be commodities. So if we add on the CRB commodities index, let's just hide US 10-year and gold for, well, let's keep gold there for a second. You can see that commodities, the CRB index, is much more closer correlated to inflation expectations compared to something like gold, right? So if you really wanted to try and hedge and outperform inflation, then certainly it makes more sense to rotate out of something like gold and rotate some of that allocation rather into something like commodities. If you take a look at the performance for something like just oil alone, this is the green one is obviously the CRB index. But if you take gold and oil alone, oil's performance has been massive over the last couple of months as inflation expectations have started to accelerate. I think it's up 10% month to date. It's up 55% in the last 3 months. I think almost up 20% year to date alone. So, doesn't that look like something that makes more sense to hold as an inflation hedge? Because it's expected to firstly follow inflation higher, more closely than that compared to something like gold. And with bond yields expected to rise, which places potential downside pressure on gold because of real interest rates potentially moving higher, for me, it just makes more sense to reallocate capital away from something like gold and allocate that into something like commodities, even if it's, whether it's the CRB, a broad-based commodity index, or whether it's oil or something. For me, if you really wanted to protect a portfolio against inflation, it makes sense to try and outperform it and not just hedge against it. So, but like I said, that second part is in terms of portfolio allocation is really more on the speculative side. I'm sure there are going to be much smarter people out there than me that might disagree with me regarding that second part. But for me, it makes sense, from a purely portfolio allocation point of view. Why would you, especially in the current steepening environment with the yield curve, why would you allocate to gold as an inflation hedge when you can just, allocate to broad-based commodities like the CRB that is expected to follow inflation a lot more closer? So I hope that helps with the question. Any others, please don't hesitate to let me know.